This week, the world of AI felt like it was pulling in two completely different directions. On one side, you had this mind-blowing innovation, and on the other, well, some pretty serious financial jitters.
It's this really fascinating paradox, right? The AI models themselves are making these incredible leaps forward, getting smarter by the day. But the market, the money that funds all of this, it's starting to get really nervous. So you've got amazing new tech, but also these growing bubble fears. What is really going on here? Let's get into it. All right, first up, let's just talk about the sheer speed of innovation here. I mean, it's been nothing short of breathtaking. We're not just talking about little tiny steps forward. No, this progress is happening at a truly record-breaking pace.
The competition is just fierce. You've got the big players, OpenAI, Google, Anthropic, all dropping these incredibly powerful new systems. But what's really cool is how they're all starting to specialize. They're carving out their own niches. So you've got OpenAI's GPT 5.2 with this massive context window. It can digest enormous documents. Then there's Google's Gemini, making huge leaps in image generation. And Anthropic's Claude, it's showing off these wild breakthrough skills as a self-improving agent.
And this number, this perfectly illustrates that whole specialization point. So that 80.9%, that's the score Anthropic's Claude Opus 4.5 got on what's known as the SWE bench. It's a really tough test for software engineering. And get this, it is the first model ever to break that 80% barrier. That's not just a small improvement. It's a huge, measurable leap forward in a super complex, super valuable skill.
And it's not just the models themselves. The development cycles are also hitting light speed. I mean, OpenAI dropped GPT 5.2 just 3 weeks after the last one. 3! That is one of the fastest turnarounds for a major model the industry has ever seen. It just goes to show you the pressure to innovate and one-up the competition is absolutely relentless.
Okay, so the tech is peaking, right? Everything's amazing. But just as that's happening, the whole financial story takes a really sharp turn. All that excitement happening in the labs, it wasn't quite making it to the trading floor.
So on December 11th, we got a perfect snapshot of this split. The tech giant Oracle comes out and says, hey, we're spending billions on AI. But they also missed their profit estimates. And the market, it did not hesitate. The stock plunged 11%. And what's crazy is that this was on a day when the rest of the market, the Dow Jones, was actually doing pretty well.
And look, this wasn't just about Oracle having a bad day. Not at all. Analysts started seeing this as a major shift in how investors were feeling. This phrase, a rotation away from the AI trade, started popping up everywhere. And what that basically means is that money was actively being pulled out of those big AI stocks, the ones that had been the darlings of the market for so long.
And that fear spread like wildfire. It started hitting the biggest names, the companies that build the actual hardware for this AI boom. We're talking about the chip makers. Nvidia and Broadcom both took a pretty significant hit. So it really makes you wonder, right? Why the sudden panic? What are investors seeing that's got them so spooked?
To really get to the bottom of this, we've got to look at the economics behind this whole industry. And frankly, the numbers are just staggering. They're almost hard to wrap your head around. And they point to this potential disconnect between how much is being spent and how much is actually being earned.
Okay, let's start with this number, $400 billion. That's the estimated annual spending by the big tech companies just on AI. So where is all that cash going? Well, the vast majority is being poured into building these absolutely massive, power-hungry data centers.
Now hold that $400 billion in your head for a second and contrast it with this number, 3%. Yep, despite all those billions being poured in, reports are saying that only about 3% of the people using these fancy AI services are actually paying for them. I mean, that is a gigantic gap between cost and revenue.
And to pay for all this construction, the industry has had to take on a mountain of debt. We're talking about $100 billion in debt just to build the infrastructure needed to run all this. That is a seriously heavy weight to carry, especially when real solid profits seem pretty far off on the horizon.
So, how are they managing all this? Well, a pretty concerning trend has started to pop up. The use of these complex financial tools called special purpose vehicles, or SPVs. Let me break it down. In simple terms, an SPV is basically a shell company. Its job is to hold all that data center debt, which means it doesn't show up on the main books of the big tech firms. It's a way to make them look a lot healthier on paper than they might actually be.
And this is where it gets really tricky. This whole SPV setup allows for something called circular financing. Let's walk through how this works, because it's pretty wild. Step 1. An AI company agrees to buy a bunch of chips from a chip maker. Step 2, that same chip maker then turns around and invests in the AI company's partner, that SPV we just talked about. And step 3, the AI company uses that exact same investment money to pay the chip maker for the chips. See what's happening? The result is that demand looks way, way higher than it actually is. It's a financial sleight of hand, and it's a tactic that's making a lot of analysts very nervous, drawing some pretty uncomfortable parallels to the dot-com bubble.
So you've got this tension, right? On one side, incredible, real innovation. On the other, these super risky financial games. And all of this is creating a brand new landscape, one with challenges that go way beyond just writing code or raising money.
A new bottlenecks for AI growth. They're not just about money anymore. They are physical, they are geopolitical. For instance, we're literally seeing an energy grid crisis. America's largest utility is having to completely re-engineer its grid just to handle the insane power demands of AI data centers. Then there's the cybersecurity gold rush. Startups are raising hundreds of millions to figure out how to secure these things. And on top of all that, you have the rise of what's being called sovereign AI, where nations like China are racing to build their own hardware so they don't have to rely on anyone else.
So, here we are, at a real inflection point. There is absolutely no doubt that the technology is advancing at a world-changing pace. It's real. But the financial scaffolding that's holding all of this up, it's starting to look pretty shaky, and it's being seriously questioned. And that leaves us with the big, critical question for the future. The progress is real, for sure, but is the financial foundation it's all built on just hype?